This meeting of the Group Insurance Committee is called to order at 4:05 p.m. We'll move on to roll call, item 1.02. Rachel?
Okay. Jeff Bozzo,
Present.
Eric Diamond,
Present.
Mike Dixon.
Here.
Thank you. I'm here. Tony McMillan.
Present.
Thank you. Vicky Cooper. Not here. Dawn. Not here. Robert.
Here.
Joseph Silvera. Not here. And Mary Beth Akers. Not here. Thank you.
Thank you. So moving on to section 2 of the agenda, item 2.01 is presentation and discussion of Washoe County School District Insurance Internal Service Fund as of March 2024. This item is for presentation and discussion only, and we have the district's controller, Marty Williams, with us to present this information.
Thank you, Chairman. For the record, Martin Williams, the district controller. As you can see through the financials, we are in a much better position than we were last year, only having a $2 million loss, as opposed to the almost $11 million we were at this time last year. The big differences, we have about $6 million more in cash. That's mostly for investments. We do have a change in the rebates from the last time I was before you. We did an analysis and found that they were over accrued at the end of last year, so we've made an adjustment to that. We also found we have a new senior accountant who's been doing more analysis for us and is finding some things that we haven't been paying attention to. The IBNR transactions were being put into the wrong object codes. The numbers were correct, they were being put in the wrong spot. So we're correcting that in May. So that's why those numbers look a little weird compared to last year. The one other thing I noticed is that the PEB is a bit shorter than it would be this quarter. That's because the March transaction didn't happen until April. So that was $218,000. That should be in that number for March, but it's in the April period. Any questions? Thank you.
Thank you. Okay, next we have item 2.02, presentation and discussion of Washoe County School District Group Insurance Claims Experience Report as of April 2024. This item is for presentation and discussion only, and we have Lloyd Barnes and Nate Kerr from LP Insurance here to discuss this. Welcome.
Thank you. Good afternoon. Nate Kerr with LP Insurance for the record. I drew the short straw this afternoon, so we'll go over the report. We'll go over the rate projection after that, and of course I'll hopefully get Lloyd to chime in on a few things. Everyone here fairly familiar, I understand, with the report, so let's go over the April report for Washoe County School District Employee Benefits Plan, turning to Exhibit 1. The executive summary, you can see the employee enrollment is up just a little bit, about 2.2%, averaging 7,142 employees per month for the current period. The total number of dependents is just about flat, almost exactly, averaging 4,366 per month. Net paid claims is down about 2.5%, running about $5.7 million a month. And when we bring in that slight uptick in enrollment, our composite number comes down a little bit, about 4.5%, lower than the prior period, running a composite employee cost of $811.39. Our fixed costs, so far, last go round, pretty favorable. We're down about 7%, averaging $360,000 a month on fixed cost. When we bring all that in together, claims cost and fixed cost for our total plan cost on line 7, all in, running just shy of 3% lower than the prior period at $6.1 million per month. Taking the enrollment into account, that gives us an $861.90 employee composite rate, change of about 5%. Large claims, we have 3 that have been identified year-to-date that have violated the 50% threshold of our specific stop loss, that being $212,500 being the threshold. Obviously, it looks low, but I'm sure everyone understands we're early in the year, and those generally tick up as we get further into the stop loss cycle. Exhibit 2, actually, I'll refer back to that. We'll come back and touch on that a little bit when we get to the rate section discussion. Exhibit 3, notables, I would say, given that we already went over all this in the executive summary. Prescription drug costs, line 24 and 27, definitely running favorable, which is nice to see. The trend factors generally in that space are a little bit higher than they are in the medical, so it's nice to see. Other than that, as we already went over in the executive summary, things are running very stable. Stable is good in this space. Turning the exhibit to, we have a lot of pages in here. The large claims, exhibit 12. As I said before, year-to-date, we have 3 that have violated the 212,500 mark, which is half of our specific, which is exhibit 13, the next page, and you can see none have violated stop loss at this point. Have a little bit more discussion on large claims when we get into the rate discussion, but overall, looking good. Questions?
It doesn't look like we have any questions from the committee, so we will close that item and move on to item 2.03, presentation, discussion, and possible action to provide a recommendation to the Board of Trustees of changes to the Washoe County School District's health insurance plan for the 2025 plan year to include a premium rate increase of 2.57%. This is for possible action.
Thanks. Nate Kerr with LP Insurance. As everyone knows, this is the time of year when we go through the process of conducting our rate projection in order to get our cost estimates for next year. We've gone through that process, completed it, and as Jeff mentioned, we came out with 2.5%, why is that hard to say? 2.57% increase above current. Minimal, good number, good to see. Some things to take into consideration that I had mentioned earlier. The cost graph on Exhibit 2 in our report. Generally like to refer to this just to get a visual of kind of where the plan's going from a cost and premium versus claims, or funding versus claims perspective. And you can see that the plan is running just about right where it should be. So obviously claim cost trends upward, it always has, right? That's the nice yellow line, the linear line. And given that costs continue to trend upward, we feel a minor adjustment is absolutely justified. We're confident with that. There were some additional considerations or assessments that we took into account or researched through this process, and that is our large claim activity. I've often, when I go over the stop loss renewal with the county, we talk about severity and we talk about frequency, right? We have a lot more frequency, a lot more of these large claims, and the severity is also up. They're bigger. Thankfully, we have stop loss for that to protect us against the big stuff. The stop loss kicks in at a pretty high level. So we kind of took a look at, well, where are the claims running that are below the spec, 425, but over the 50% threshold, which we would identify as a large claim. Might be some argument you could identify a large claim as $50,000, but and those claims between 212, 425,000 have grown significantly, both in frequency and severity over the last 3-year cycle. 2020 was a bit of an anomaly. It was a very favorable year in that regard, but every year since, we've had significant double-digit inflationary trends in that space. So nothing to be too alarmed about. The actual overall activity of the large claims at school district is pretty stable, right? We're not seeing very large amounts, fluctuations year over year. It's the cost. The cost in that space is growing substantially. So again, I bring that up not to alarm anyone, but just to say that additional consideration of why maybe a small increase is definitely prudent and makes sense. Questions?
Robert?
I have two questions. One of them, I just want to ask, I know Lloyd talked about this last year, that we hadn't really been seeing the inflation that other plans are necessarily seeing. Is that starting to be something that we're seeing? And then the second one is, we used to, and we don't do it anymore, obviously, do the different levels of confidence, but what confidence did you set, was this set at?
Lloyd Barnes, LP Insurance for the record. Robert, I would say the school district's plan is still pretty favorable as far as those inflationary pressures. For many of our other clients, both self-funded and fully insured, we're seeing quite a bit bigger numbers than these play out. So from that standpoint, favorable. Let's just go with favorable. And from a confidence interval perspective, this would be considered the 50% confidence interval perspective. No adjustments to it. It's basically just flattened by the book, which we've done the last, I think, 3 or 4 or 5 years now. Use that same methodology.
Are there any other questions before we get into discussion? Tony?
Yeah, Tony McMillan. Last year, the large loss that you explained, we had 5 large loss claims at this time last year. Do you know what it was previous to that? And is there a graph, like a multi-year graph, that shows both dollar and large loss that we have that goes beyond just the past year?
Just to clarify, are you talking about ones that went over this specific stop loss that we had reimbursement and protection for, or ones that went over the 50%?
Kind of when we start tracking them. We start
The
tracking
large
what, the
claim threshold, the 50%.
225,000, yeah.
Yeah, I do have a summary of those numbers. The number of claims over the 50% threshold is floating somewhere between 20, 24, and 30 on average for the last 5 years. The number of claims that were over that 50% but under the specific 2019 and 2020, this is that space I was talking about, right? 2019 and 2020 was at 15, and then 2021 it jumped to 25, 2022 went 24, 23, 26 total for 2023.
So we've been pretty stable as far as large loss, just number-wise, dollar-wise as
Yep.
well?
So the counts have been, the activity has been relatively stable. That was where my comment came from. It's the cost, right? So average cost starting in 2021 jumped up pretty significantly, almost 20% in that space, in that over 50 but under spec. And then the 22 and 23 also went up double digit, 10 to 11% in that space.
Okay, thank you.
Question, Robert?
Yeah, I was just going to ask, one of the things that's down on the numbers right now are fixed costs. They tend to be running down a little bit, which is good. But my question is, and that's because we have good contracts, but my question is, do we know when we renew our contract again with Anthem? And, is that 5 years down the road? Is that 1 year down the road? Because that's going to impact ultimately our rates at some point.
You want me to take this one? Okay. Mackenzie Harn for the record. Thanks for the question, Robert. We actually just went through our process with business and LP, and we're going to propose a 3-year contract renewal with Anthem, which would begin January 1st, 2025.
And these numbers take that contract renewal into account, right?
Do they? Yeah.
Okay.
All right, any other questions before we get into discussion? Do we have any public comment on this item? No? All right, then I'll open it up for discussion. If anyone, Rachel?
Rachel Drake. So I just want to remind, as we come around to this discussion every year, we do, that these increases, while they don't impact any of our folks who are on an employee-only plan, they do impact our families, they do impact our retirees, and we just raised all of their costs a significant amount in this last year, and we are currently looking at a fund balance that is healthier than it was last time, last year at this time. So just things to think about.
Mike?
You should remind me, do the rate increases go into effect fiscal year July 1 or are they January?
It's January. Robert?
I just have two comments, I guess. One of them is, I don't doubt that we probably need to raise rates at some level. And I'm not even sure that I disagree with the 2.57%. I had to pause there. But I do believe, and we've brought this numerous times up over the years, that really it's important for us as members to take this back to our associations, have discussions, and then kind of bring that with our boards and then bring that back. So I really don't believe in necessarily voting on it the same day we hear the presentation. So I really would like to take a month, come back next month and vote on this. The second comment that I have, or discussion, is this, normally we also get a list of things that could be planned changes to offset some of that, like deductible changes, copay changes, things like that, and we don't have any of that. And I know that several members of the insurance committee over the year have talked about plan changes that would affect the plan cost, which might increase this amount from 2.57%, or decrease the amount depending on what we do. And that's not being discussed here. So I just think that, I think we need a month and we need to have time to digest it, take it back to our associations, our boards, get some feedback, and then come back. Because I don't doubt that we need to raise the rates. Inflation is going to hit us at some point.
Tony?
Mine's similar to Rachel's. I mean, last year we were asked for, if I believe, I remember right, an 8% increase. We settled on a 6% increase that we were gonna draw down our balance. And what I'm seeing is our balance has gone up, yet we're still asking for an increase and no changes in benefits, is what Robert's saying. Large loss, I hear the costs are going up, but we've been pretty stable. It sounds like set the COVID years aside, but it's stable in the mid-20 range. So I don't know if I'm prepared for a 2.5% or if it's actually justified right now. I think I need some time to digest that, and we're trying to predict 18 months too, so that's a little bit hard as well. But I think with a better position and what we did last year, I don't know if I'm in support of 2.5%. Because we haven't drawn down the balance that we discussed. So that's where I sit with it.
Eric?
I'm in the same boat. I think we've had a number of years that we've considered serious rate increases, serious percentages. Initially, the sticker at the 2 point some odd percent seems pretty good, except for the fact that we haven't considered all the other options that we have, to include the fact that the fund balance is very healthy. Having some time on the board, seeing the fund balance go anywhere from 17 to 25 million and now up to 35. Did I read that right? 38. I think it absolutely lends us plenty of time and opportunity to consider easing any rate increase on the members, given the other financial challenges on the outside.
Mike?
On my quick principal skill math level, my calculation is that's less than $20 for the most impacted family per month, which I think is important to put a dollar amount to the percentage amount. But I would be curious, I just don't recall now from the previous presentation, if we made no rate increase and we did just continue using surplus cash, what is the actual per month cost on that over the 12, 18 months we're talking about. Am I clear on that? Like, we're currently running a bit of a deficit. How much is the deficit again, the monthly? I feel like you said $1 million.
For the year, 2.2 million down for the year.
So for the fiscal year, it's been 2.2 million, so that's
Thank you, that's helpful.
$150,000 a month. Sorry, Robert?
I just was curious if we have numbers, because Rachel brought up a really good point about retirees. They bear the brunt of this completely. And I'm just curious if we know, I know once they go on Medicare, that changes a little bit, but do we have numbers on the number of retirees that are still on our plan? Because I know some of them have left for other plans and things like that. Medicare Advantage plans, which we can offer.
Lloyd Barnes, LP Insurance for the record, that'd be on Exhibit 5, Robert, the retiree counts.
Yes, Robert?
Does Exhibit 5 show the ones that are not, that are on Medicare, or is this just all retirees?
That would be all retiree.
Okay, but it doesn't break that down, okay.
Any further discussion on this item? Does anyone want to take a stab at a motion? No? Okay. All right. So Robert, do you have a question?
I was gonna make a motion if you wanted.
Okay, yeah, so we'll look for a motion to move this to the next meeting for consideration of the same proposal.
I move that we reconsider this motion or this item at our next meeting where we can discuss possible plan changes as well as the number that we're looking at for the increase.
Do we have a second?
Can I ask a question on that?
Okay.
When Robert asked for plan changes, will Lloyd take a look at maybe some recommendations for possible plan changes based on previous year's discussions?
Lloyd Barnes with LP Insurance. Thanks, Tony, for that prompting, because I was going to actually add a little comment there. If there's anything in particular that we would like to look at, we'd love to hear that. You know, obviously, we can throw the normal things on the chart: deductibles, out-of-pocket max, co-pays, in the various configuration and menu like we've done in the past. That's not a problem. But if there's anything in particular beyond what you would normally have seen in previous years, please let us know, or please provide that to Mackenzie so that we can review that accordingly.
Do we have a second on the motion?
Well, I was gonna maybe just respond to that I would say, I think the regular slate of, specialty co-pays and regular co-pays, that's kind of the normal topic. I don't know of anything particular. Robert, do you?
Should we request at this time perhaps a lower rate increase, what that would look like? Like a 1.5% or 1% instead?
Why don't we withdraw the motion since it's kind of
Okay.
pending?
Yeah.
And then
Well-
reinsert this once you guys figure out what you want to bring
Okay.
back to the next meeting.
All right,
Thank you.
thank you. So,
So you withdraw your motion.
I'll withdraw my motion.
thank you, Robert.
Doesn't matter. Can't take
Okay, so far what I've heard is a lower rate options and then various plan change options.
And-
Robert?
And I think what Rachel might, I'm not put words in your mouth, but I think what you're saying is ultimately what a lower rate impact would have on the overall plan, you know, overall ending fund balance and that kind of some projections on that. So if we went with 1.5%, how might that impact the plan? So we would at least have that.
Yeah. Mike?
You know, the biggest complaint I hear from folks is concern around how much copays have increased. So I'm just wondering, as we're talking, is there any way that we can look at other options if we have a surplus of cash? Like, could we go through a phase of reducing copays and absorb some of that cash? I know this is my second or third process this round with you guys, and retirees are often a concern. Is there a way that long-term we can make an adjustment so they just have a different option? I feel like last year we talked about that and that's more contractual maybe.
So, I mean, I think this was maybe let's go back 4 or 5 years. So for the January 1st, 2020 rate discussion, I think we needed to get to 5%, and committee members wanted to lower co-pays, I think, for physical therapy, other therapeutic options, and we did that as part of, we still had to get to 5% total, so there were some other offsets to it, but it's something we've looked at in the past. Eric?
So we've done rate or plan changes to kind of offset the percentages in the past. With such a small percentage that we're dealing with thus far, I would I'd kind of lean against that, because, I mean, if we cut 2.5% of coverage, you know, it's just to save the dollar on the other side. I just don't see, you know, or even if we did like a 1% loss of coverage and a 1% increase in the cost, you're paying more for less. Exactly, and so I think I think that the combination works better when the numbers are bigger.
Mm-hmm.
I think a smaller number like this, personally, I'd lean more towards probably no rate increase and letting the fund almost take the brunt of it.
Yeah, I want to clarify on that because I appreciate you explaining that. So I think where I was going with my thought was if we did no rate increase, because a few of you suggested that, because there is obviously cash to absorb that, right? What if we did something in addition to that? You know, so like I'm hearing a lot about like $50, $60 copays, right? So to me, it's like if you're a family and you're struggling, just as concerned about retirees, if there is, like at what point is there, and I hear you, Tony, often say like at the cash surplus as it grows, at what point can we say it's grown enough to perhaps benefit the good of the group in a different way? And so I don't know totally what that looks like, but an initial process, just random thought would be, you know, to say like, hey, co-pays for primary care provider are 20 this year because we're reducing that cost through the plan somehow. I'm just trying to come up with ways that we could maybe better support all of our folks by accessing some of that money. A little different thought. Does that make a little more sense where I'm trying to go?
Yes.
In addition to not raising rates, you know what John's.
Robert?
I just, several years back, we didn't raise rates, and I was really, as a chair, kind of concerned about that, because what I didn't want was to come back the next year with the 6 or 8%, and that's what we ended up with. So I would rather honestly do like 1% this year or 2%, rather than come back next year, inflation's hit, and now we're at 10%, and we're struggling. And so, yes, we have a healthy balance. Yes, we can absorb. Maybe we don't need to do more than, 1%, but I don't want to personally walk away and say we're going to do nothing and wait a year and just see, because I've been on the other side of that where we end up getting hit down the road and it's a lot bigger, and we spend weeks as a committee and hours, 6-7 hour meetings trying to figure out how we're going to get through this. And then send it to the school board, and then they send it back to us, and we just kind of go back and forth for a long time. And so I just want to avoid that. And I also think, Eric made a really good point about nickel and diming people to death. We want to keep our plan and make it a rich plan and make it worthwhile. But I also, sometimes you do have to raise copays, but, also I think keeping it rich is important.
Thanks, Robert. Before I get to you, Eric, so thanks for bringing up past rate changes. You know, haven't been on the committee for significant rate increases, but I was on the other side of the table presenting financial data when we were looking at 10% rate increases, and that's probably one of the most difficult conversations to have as a committee, and also taking back 10% increases to your members. Also, you know, from the district's perspective, budgeting a 10% increase is very difficult. And then the board approving a 10% rate increase is extremely difficult. I also favor a small rate increase. I mean, if we go back to, I guess if this were to be approved in the future, then over 5 years, the average rate increase is 1.7%, which is very small. I would not like to get into a situation where next year, if we don't approve anything, that we're looking at, you know, a 10% rate increase. Have we built up net position in the fund? Yes, but we still have a loss of $2.2 million this year, and that will likely grow into a larger loss. So, you know, we can't operate at a deficit forever. There are catastrophic claims from time to time. From year to year, those obviously vary, but I think it would be in our best interest and the district's best interest to go with you know, a lower rate increase in this year and try to offset future larger rate increases. Eric?
My understanding isn't complete as far as internal service funds, but the insurance fund itself is an internal service fund of the district itself, right?
That is correct.
And so the funds themselves, and this is a little bit more towards your direction, Mike, is the fact that if we're running a savings, in essence, and our internal service fund, our insurance fund is building, and that's saved from services to our members, those funds are still under the direct operation of the district. Those funds can be moved out of this fund. Is that correct?
I don't believe so. I mean, they're for the purpose of the health insurance fund. I don't know if we've ever transferred funds out of the health insurance fund before.
And the root of my question there is is OPEB fund refunds almost, where OPEB has kind of offered or, you know, kind of influxed money into our account. Can that be withdrawn or recalled? And the root of it being that I just don't want us to save money on behalf of the members, but have the money reallocated in an internal service fund without us utilizing it.
So are you saying if OPEB, you know, contributed, was it like $5 million last year, if they were like, no, we want that back? Is that what you're asking?
Maybe not directly in those means, but it's my understanding as an internal service fund that, you know, the Dominion is held by the district to move those funds as they see fit or necessary, beyond any legal concerns for funding the insurance to a certain extent. Mm-hmm. Can funds be at the will of the district be moved from this internal service fund to others?
I don't have a clear answer on that. I have to look at the fund resolution when the fund was approved to see if that would even be an option, but I would lean towards that not being something that could be done, is for the purpose of the health insurance fund and health insurance costs for employees. Robert?
I don't know if the district can actually arbitrarily move it, but I do know that during the recession, we had premium holidays, which our members didn't have to pay, but also meant the district didn't pay premiums for those months, which basically kept their funds at a higher rate and impacted the insurance fund because those premiums weren't being paid in. So in a roundabout way, yes, the district has been able to reallocate those funds through a premium holiday, but I think that was really an anomaly of that recession. The same thing with people taking furlough days and everything else.
Yeah, and back then that got us down to, I think, like a $2 million fund balance when we were having the 10% rate increases over multiple years. And then we were fortunately able to have an infusion of $5 million per year. I think it was 2016, 17, and 18 from the OPEB trust fund to help the fund. Those were really bad times. Anyway, but that's when we draw down fund balance too much, or we have a really bad year of large claims, I can draw down on the fund's net position, and then we could be looking at significant rate increases the next year.
And I appreciate the perspective on that, because my entire time on this committee, I've never seen the fund below 17 million. So I don't know the before times.
Yeah,
So I appreciate the perspective on that. Thank you.
absolutely. Robert?
There was a time when I first got on this committee when they gave us the 10-year thing, and it was like 5-6 years before I got on this committee, but it was in the negative. So the insurance fund was in the negative for, I don't know how many years it was, but it was quite a few. So that has happened, and when we get down to 2 million, that's scary.
Yeah. Okay. Any other discussion on this item? All right. I guess we could put a motion back out there. I believe last time it was, or I believe what I'm hearing is to move this for consideration at the next meeting with options, with lower rates and also plan change options. So I don't know if anyone wants to make a motion regarding that. Robert?
I'll move that we reconsider this item is it 2.02? Or no, 2.03,
2.03.
sorry, at our next meeting, including possible lower rate changes and the effect on the plan, as well as possible plan changes.
Do we have a second?
Eric Time, and I'll second.
All right.
I do have a question for this item before we close it, or vote, sorry.
All right. Yes, your question?
If I bring this up to discussion for my members, we're considering, at right now, there's a possible 2.7% rate increase overall, right? And that's 2.7% on the $3 million per year loss?
No. Lloyd, I'll let you jump into this one.
Just so I can present it correctly to my members.
Yeah, no, Lloyd Barnes, LP Insurance. The rate adjustment would be on the overall plan costs. So not on the deficit. So it would be, think of it as even though it's self-funded, so it's not a premium, the overall cost of the plan between what the district pays and what employees pay and retirees pay for the plan. So the funding, we call it the funding amount. Increase of 2.57% in funding for the plan.
Okay, so would it also be safe to describe that as a possible 2.57% increase on the individual per person cost, like the 800 some odd per person cost?
That's what this particular matrix shows you exactly. It doesn't, it's actually less than that, and you can see how that breaks down in the matrix as to the percentile, because you have to add in all the other expenses. So you can see how that breaks down, and that, I think, goes back to Mike's point of the dollar amount, which is you can just sort of subtract the year over year.
Which exhibit is this?
This
Or is not?
yeah, should be in your packet, and it would be the employee paid column from period 1, period 24 to period 25. And I might ask for one point of clarification on the motion. What level of premium increase would you like to see?
Robert?
Well, we're looking at a 2.57 right here, right? So what would half of that be? be 1.25 or whatever, and maybe a 1%, give us like 3 levels.
Okay, so half of the projected 2.57 roughly and 1%.
Yeah.
Thank you for clarifying. Makes our life a little easier instead of just throwing darts.
Okay, any other discussion on this item? No? All right, then we'll take a vote. So all those in favor, say aye.
Aye.
Any opposed? All right, motion passes. Nate, Lloyd, thank you very much. All right, we will move on to item 2.04. This is presentation and discussion of Washoe County School District Group Insurance Wellness Program Report to cover current events and programs as of April 2024. And this item is for presentation and discussion only. And we'll hand it over to Mackenzie Howard.
Hi everyone, Mackenzie Howard for the record. So the last time we met, I mentioned that our mindfulness-based stress reduction program had just wrapped up. And the instructor who hosted this program implemented a pre and post test. Each of them were anonymous for an evaluation on this program. This was the first time we had ever implemented this program, so we wanted to see if it was positive or negative for our members. We had a pretty small sample size, but if we look at the quantitative data, we had very strong and positive impacts. 7 out of the 9 participants said that their stress levels and overall health were improved. And this was found comparing their pre and post test. I wanted to clarify that. And then the other key detail we found was that 88% of them said that their attitude towards their health improved. And then we had a few structured questions that we asked them. And the piece that I wanted to highlight was the first comment there, that this person who completed the program is able to handle hard situations at work better now with a more calm reaction. And then they also went on to describe some general health impacts that they saw in their personal life. So overall, very positive impacts that we found here. Any questions on the program or the data itself?
Yeah, I have a question. So when it says 7 out of 9 participants, is that we only had 9 participants in the program, or only 9 people chose to take the survey?
We had 9 people in the program, and 7 reported that their stress levels and overall health improved.
Do you know how much we spent on this program?
So the program was implemented on a reimbursement rate. So the participants paid for it up front, and then if they completed it in its entirety, then they were reimbursed for it.
Okay, so there was.
So it was less than 4,000 total.
Okay. All right. Thank you.
Yeah.
Any further questions on this item? No? Okay. Thank you, Mackenzie. All right, we'll move on to the last item, item 2.05, approval of the minutes of the March 20th, 2024 meeting of the Group Insurance Committee. And this item is for possible action. Do we have any public comment on this item? No? Okay, thank you. All right, well, if anyone's ready, we can entertain a motion for this item. Rachel?
This is Rachel Drake. I move that we approve the minutes as written for the March 2024 meeting.
Is there a
Second.
All right, any discussion on this item? All right, all those in favor, say aye.
Aye.
Any opposed, say nay. All right, motion passes. Oh, that brings us to our closing items. Item 3.01, public comment. Do we have any public comment? No? All right, thank you. Our next meeting is scheduled for June 26, 2024, I believe 4 p.m. here, same location. And with that, we'll adjourn the meeting.